So what are we going to talk about today? We're going to talk about tax policy and budget reconciliation. Budget reconciliation is the way this tax bill for the Trump administration is going to go through, because it's the only way that you can get by with only a majority in the Senate without 60 votes. So we're going to first explain budget reconciliation, because that's the process that's going to shape what's going to happen in tax policy. Then we'll look at the extensions of the 2017 Tax Act, look at other tax proposals, revenue proposals, how this all fits in with the debt picture. And then we'll talk about legislative strategies. So here's the basic message, that the debt increase limitation on budget reconciliation will be the key driver of the legislative process. But there are a lot of legislative games that can be played to circumvent them and to minimize that increase. So we'll get to that at the end.
So it's slide 16, you're going to bring it all together, the two of you? You're going to land this one?
That's right. We'll bring it all together, talking about what sorts of games people can play to keep that number way down. Okay. So next slide. So budget reconciliation is an expedited procedure for passing a bill that can only relate to tax and spending. That's all it can relate to. And there has to be a reconciliation bill that gives instructions to the congressional committees, which includes, most importantly, a deficit limit over the next 10 years. And then, in addition, the reconciliation bill cannot worsen the deficit beyond the 10-year window. So those things are what suggest that this bill is going to expire in 5 years or in 10 years. So it's in order to reach the deficit limit. Okay, next slide.
So when you hear they have increased debt ceiling, is that
We're going to sit over this next to CD tax.
No, this is not part of the increase in the debt ceiling. This is a separate requirement that's part of the budget reconciliation process.
And then when you ask a question here in the room, speak with your projection voice, because the microphone is way down here.
I mean, ultimately, if there is a deficit increase, it will go into the debt ceiling. But this is a separate requirement. That is, when you get the Budget Reconciliation Act, it says you can only raise the deficit within 10 years by a certain number. And next slide. And that's the way you get to a majority vote in the Senate rather than a 60-person vote. And it looks like the Republicans have 53 seats in the Senate, and they have about 220 seats in the House. So that's 220 to 215. So that's a very slim majority. And since there are a number of cabinet nominees who come from the House, it's going to be even small, maybe as small as 217 to 250.
And one of them resigned as well. Matt Gaetz resigned.
Yeah, so Matt Gaetz resigned. So that means even one person in the House can screw up the whole process. And then in the Senate, you need 3 people can make the process.
So you would not want to be Mike Johnson right now. Is what
Yeah,
you're saying.
that's a very tough world. So next slide. So if we go back to 2017, when we had this hilarious meeting about tax reform.
We're going to do it again in 8 years when Trump 3.0 comes.
Yeah, I don't know about that one. So they used budget reconciliation there, and the deficit spending limit was 1.5 trillion over 10 years. Just for your information, it turned out that that estimate was too low, and the real number for deficit spending was closer to 2 trillion. And in any case, how did they get there? They got there by sunsetting a lot of provisions after 5 years. So lots of provisions, as we'll see, sunset at the end of next year. 2025, and some of them have already sunset.
So that's the trick. Within the 10-year window, you just sunset at different times.
Right, and that allows you to reduce the deficit estimate. And so the first thing that has to happen in tax policy is that you have to extend the TCJA, the Tax Policy Act of 2017, because if you don't do it by the end of next year, all these goodies are going to expire, and that's going to be a political disaster. So this slide gives you a summary of some of the individual tax provisions. And just to go over them quickly, the top rate went down from 39.6% to 37%, but significantly, all the other rates went down in the brackets. So this is clearly something that most politicians want to continue. The second thing that happened is the standard deduction went up to 24,000, and as a result, and personal exemptions were eliminated. And as a result, there are a lot less people who are itemizing, and that's viewed as a really good thing because it makes people's lives a lot simpler. The AMT, which caught a number of high-income people, the exemption was increased, and so was the phase out. So that doesn't hit as many people. And then there was a special provision for individuals who have business income that allows them to deduct 20% of their business income each year. That's pass-through income. When they're organized like as an LLC.
They must be wildly popular with small businesses.
It is what all these provisions are widely popular, but that provision particularly is very popular with small business, since any business organized as an LLC or subchapter S can take this 20% deduction for the income that comes out of those things. So all these are going to expire at the end of 2025. So the first order of business for tax policy is to extend them. Now, if we go to the next slide, we can see there's some other things that are going to change. Child credit was doubled to $2,000. The mortgage interest deduction was limited to $750,000. And here's a very important that the SALT deduction was limited to $10,000. That was one of the ways that they paid for the TCJA. And that's a provision which a lot of Republicans as well as Democrats are interested in. Republicans from states like California and New York.
So predominantly blue states where you have that high base of income tax, where you still have Republicans who've made gains in the House in particular are likely to feel a ton of pressure.
Right, they are going to feel a ton of pressure. And the last one is the estate and gift tax exemption, which was raised at 10 million and was indexed to inflation. So it's now over 13 million per individual and 26 million per couple. So Michelle, why don't you go on to the next slide, talk about some of the business provisions. But we should say before we do the detail here that the one big change in corporate business tax, the rate going down from 35 to 21%, that was made permanent, right?
Yeah, correct. Yeah.
And so that doesn't have to be extended.
Yeah, that's permanent. And that was one of the big drivers of the TCJA, really, was to lower the corporate rate, change the international tax system to make the U.S. more competitive, ideally, with the rest of the nations in a way that the rest of the nations tax their companies on foreign income, and the way that the tax rates have gone around the world was down on the corporate income. And so now, the TCJA dropped the corporate rate and kind of put us more in line with the OECD average in terms of corporate statutory tax rates. But that's permanent, like Bob said. So that. I mean, it doesn't mean it's not on the table. I think everything's kind of on the table next year, but at least that's not going to sunset automatically as part of the TCJA sunset provisions.
But later on, we're going to see the dollar amounts for all this so we can all understand the relative numbers.
Right, for what Bob talked about and these provisions as well, the corporate side. So the corporate side, like Bob said, the rate's permanent, but there were a lot of things baked into the TCJA on the corporate side that basically expired over time or changed over time. So here's 3 examples. These 3 are kind of big provisions in terms of the corporate income tax base. And what was put in place in the TCJA was what's called bonus depreciation or full expensing. And what that means is when companies put in, say, equipment, they can expense the whole amount immediately. And so starting in 2022, that started to phase down so that by 2027, there will be no more bonus depreciation, and they'll look back on a regular depreciation schedule, a maker schedule that we normally have for the tax code.
Would that be something businesses really want?
Some businesses really want, yes.
Like the small business pass-through that Bob discussed, that was really important. Not all businesses equally want that.
That would apply mainly to businesses that are making significant investments in plant or
Yeah,
equipment.
capital intensive companies, yeah.
Manufacturing.
Yeah, manufacturing, yes, yeah. The other thing that was in the TCJA was a limit on interest expense, the deductibility of interest expense. What we put in place in 2017 was a limit that was basically you couldn't deduct interest expense that was greater than 30% of earnings before interest, taxes, depreciation, and amortization, EBITDA. And after 2022, it actually became more limited, more binding, that limitation, because now it's 30% of EBIT. And so if you're not used to those terms, what you can see is that depreciation and amortization are not added back to that base. So that's a smaller base multiplied by 30%. So your interest limitation is smaller. And that limitation, 30% of EBIT, is really inconsistent with international norms. Also, it's more strict than what other countries would have and what the OECD guidance would indicate. But that rule, like I said, it was 30% of EBIT to start, and then it goes to 30% of EBIT, and that's actually scheduled to stay that way, to be more strict. And that was, as Bob was saying, that actually raises more revenue basically over the window so that they could get to the 1.5 target. And that's scheduled to be that way unless they change something. The other kind of big provision in terms of the base was our research and development expensing. So it used to be the case that companies could just expense research and development expenses that they incurred, and now since 2022, they have to capitalize those costs and amortize them over 5 years for domestic research and development. So again, that's another way that the tax deductions were limited, and the government would raise revenue after 2022 to get them to this 1.5 trillion. And this is a very important provision, as you can imagine, for companies who spend a lot on research and development, any pharma, tech, manufacturing, high-tech manufacturing. So that's a big provision that a lot of companies are really concerned about. Right now, that is not scheduled to change, so it would stay the case in order to capitalize. But these 3, I would say, are all very much on the table in terms of things that the Trump administration probably wants to change back to the provision that was actually put in place in the TCJA, meaning full expensing, the EBITDA limit, and allowing expensing of R&D.
Next slide.
The international provisions.
Ooh, this is the exciting.
Yeah, this is very exciting, but extremely complicated. So I'm going to try to cover this at a very high level. So what we had before was a international tax system, mostly for large corporations, that was inconsistent also with international norms. And what we used to have was a system that would say, if you were a U.S. multinational and you had a subsidiary in a foreign jurisdiction, say Ireland or somewhere, some low tax jurisdiction, we would say as the U.S., we would say, we're not going to tax that income that you make in Ireland until you repatriate it. More or less, there were some limitations, but that was kind of the rule. We did not tax them in the U.S. until the company brought back those earnings as a dividend to the U.S. parent company at a high level. But then what we did in 2017 is we changed those rules, and because it created a ton of really bad economic incentives, like keeping cash offshore and acquiring companies offshore and incurring debt in the U.S. So we changed the system, and what we said is, okay, we're not going to have this repatriation tax anymore. What we're going to have is provisions that basically say that we are only going to tax earnings that you make in the U.S., except if we think, the U.S. government, if we think that a company has earnings in a low tax jurisdiction that's taxed, at a low rate and it's high return income, so basically intangible income, we're going to tax that in the U.S. currently as you earn it. And we're going to tax it at 10.5%. Starting in the TCJA, but in 2026, that rate is going to go up to 13.125. So again, this is another example of what Bob mentioned, what I was saying with the last three, where it changes over the window of the TCJA so that more revenue is raised and they got the 1.5 trillion. So that's the global intangible low tax income, the GILTI. It's not an accident that acronym is that way. Then the second one is base erosion and anti-abuse tax, the BEAT. That basically is a provision that is meant to prevent companies from kind of stripping income out of the U.S. to foreign jurisdictions. So, for example, paying their foreign subsidiaries interest or high royalty rates. Those types of payments now are subject to this BEAT tax. It's basically an alternative minimum tax of a sort. The final provision is a foreign-derived intangible income, and that's locally known as the FDII. The FDII is basically a carrot. That's an incentive for companies to retain income in the U.S. High return income, intangible-based income. And so what the provision is if companies, kind of complicated set of calculations, but the idea is if you keep your intangible-based income in the U.S., then basically that rate on that income is lower than the 21% statutory corporate tax rate. It's 13.125% now, and it will, though, however, in 2026 increase to 16.4. Also, again, raising that rate over the window so that they could get to 1.5 trillion.
I was going to ask you, what about the minimum tax of 15% on book income? That came in through the IRA.
That was the IRA, yeah. I'm really not a fan of that tax, but yeah, it's a minimum tax assessed on financial accounting income. Also somewhat complicated, but basically if their financial accounting income is higher than their taxable income, they'll have to pay 15% of the difference, more or less. A little more complicated than that, but that's the.
But all of this is, as taken as a whole, is to avoid large organizations to globally shop for low tax jurisdictions and avoid taxes everywhere in the world.
That's what, especially the GILTI was trying to prevent. Yeah. CANTI is a little different because that applies really to domestic income also. So the corporate alternative minimum tax that was put into place in the IRA, called the CANTI, the corporate alternative minimum tax, that kind of at a high level was really just meant to be an alternative minimum tax. So if a company has too many deductions, and such that their book income is much higher than their taxable income, and it could be all domestic deductions, really, even, then they wanted to make sure that they were paying some level of tax.
Right, got it.
Okay, so now we come to the next slide where we're looking at, well, what does it cost to extend the TCJA? And that's a critical question since there's got to be, as we talked about in budget reconciliation, there has to be a debt limit for creation of new debt. And the individual taxes cost a lot. They cost 3.3 trillion. Those are all the dropping in the tax rate, increase in the standard deduction. So that cost a lot. The estate tax, making that exemption permanent, cost a little, 206 billion. And the business tax permanence cost 643 billion. Why is that so low? That's low for two reasons. One is that, as we said, the corporate tax rate going down from 35 to 21% doesn't expire. That's made permanent. And so there's no tax, there's no cost that's attributed to keeping that. So that's a big one. And then the other thing is the book income, the financial income was done in a different act. So it's not scored as part of this. Probably the most controversial thing is the deduction for SALT. And there are a lot of people, a lot of Democrats, most Democrats want to increase this exemption deduction back to what it used to be. And that turns out to be very expensive, to be about 1 trillion. But I did some calculations, and you can find if you did something more modest, like you increased the exemption, the deduction to $20,000. So you doubled the limit from 10,000 to 20,000. That would cost only about 160 billion over 10 years.
So that would be all the taxes you pay to the state. That would be all your property taxes on your home,
Property tax.
local taxes in your,
So if you totally allowed that deduction to be for all property tax, all income tax, that's 1 trillion.
and at 20,000,
It's 160 billion.
Wow, that's a lot, right?
it's a big number.
And if really that deduction benefits the upper end of the income distribution, so that really is a benefit to the more wealthy people and not the lower income part of the distribution.
Yeah, and remember, we vastly reduced the number of people who are itemizing. So it's only relevant to people who are itemizing. So its distributional effects are very controversial, as well as the political effects in blue states versus red states. Now, we look at the next slide, we can see that as the campaign wound on, Trump basically suggested tax cuts in a wide variety of ways. And I don't know.
A lot of goodies, huh?
A lot of goodies. A lot of goodies were promised to a lot of voters / taxpayers. And I don't know how many of these are actually going to come about. I would say, my personal opinion, and Michelle may have a different view, that lowering the corporate tax rate on domestic activities, only domestic activities, that costs $361 billion. And that's something that I think is a manageable number and will have a big constituency because it's helping a lot of companies. And then the other thing is it will be limited to domestic activity. So that will have a lot of appeal to the Trump administration.
Yeah, if I can just, can I
Sure,
say one thing about
absolutely.
that? We used to have that rule, the domestic production activities deduction at different rates, back then, because we had 35% corporate rate back then, but we used to have that provision. So they basically have it just to use off the shelf. And so I think, like Bob said, that one's fairly.
That one looks
likely.
like the one that's, of all these, the one that's most likely to come about. The exemption to Social Security from income tax turns out, not surprisingly, to be very expensive. And it's not allowed under reconciliation. Reconciliation rules say that Social Security can't be done through reconciliation, which means that you probably got to get 60 votes in the Senate to do it. And it also, Social Security is slated to become insolvent in 2033. So this would just bring up that sooner. I don't think that that's a likely thing to happen, though it's obviously an attractive goodie. Then we have two other ones: exempt overtime pay from income tax and exempt tips from income tax. You notice I just said income tax and not payroll tax, because payroll tax arguably comes within the rule that Social Security can't be done through reconciliation. These numbers are in fact very low because they assume that things are static. And it's clear that if you exempted overtime pay and tip pay, that a lot of people would figure out how to make their pay more overtime and more income tax.
So Bob, I'll come over and paint your house for $1 and you can tip me whatever you want. Okay?
Exactly. And the numbers here, I saw one estimate, for instance, on exempting overtime pay that went as high as 2 trillion. And on tips income, this is only being calculated in W-2 income. There's all that other tip income that would come into play. So I have to say, of all these things, those two are, I think, very unlikely to happen because they would establish really big holes in the tax code and would be controversial. Exempt Americans abroad from income tax doesn't cost that much, but there aren't that many voters who are in that position. So I'm not sure that will pass. And then itemized deduction for auto loan interest. That was another one that Trump threw in there in some campaign stuff. So it's hard to tell about all these. So going back, I think the 21 to 15% for domestic activity seems like the one that's most likely to happen. Both Kamala Harris and Trump agreed to exempt tips from income tax, but I'm not sure that's going to happen. It's so controversial in terms of design and how it would go about, how people would go about this. Now, next slide. So then in the reconciliation process, you have a chance to have get credits for revenue that's raised or spending cuts. And so
Because you're somewhere in the 5, 6, $7 trillion range at this point, and that seems like a really big number.
yeah, so if we just took all the things that have been wished for, you have TCJA alone is 5 trillion. And then if we add all these other ones, we're up to 7 or 8 trillion. And as Michelle will say, our debt situation is such that that would be pretty disastrous. So people are going to look for revenues, and Trump has said that he doesn't like the green energy credits, but there are 18 House Republicans that have signed a letter saying that they don't want him to repeal these credits because they're job creators, and in places like Texas, they're creating a lot of jobs. So I think there might be some cutback on energy tax credits, but I doubt whether it's going to be at 921 billion. And then you have tariffs. So this is, again, an area of great controversy. The Tax Foundation has estimated that he had a 20% tariff on all imports and 50% tariff on imports from China that would generate up to 4 trillion. But of course, that's very speculative because you're also assuming that people are going to continue to import that level, which probably isn't true. And you're also not taking into account retaliatory tariffs. So that number is a total guesstimate. Moreover, the way reconciliation procedures are written now, tariff revenues don't count unless they're done by legislation by Congress, not by executive order. As we'll see, maybe that could be changed. But so I think the idea of adding all these revenues would be from tariffs would be particularly controversial.
So Trump at the New York Economic Club was leaning in on this. Tariffs are going to be so big, they're beautiful, they're going to pay for everything. He's hanging his head on this. Are other economists along with him on that? I presume not.
A lot of economists say that it's a threat that he'll use to get other things done. And I mean, he's said 25% on Mexico and 25% on Canada. Well, that would violate the agreement we have, which is supposed to be negotiated. So I don't know. He's already said, well, to Mexico, they've got to stop all these people at the border, and that's the way you do it. I don't know. What do you think?
Yeah, we don't know. It could be a threat, merely a threat, or it could be for real, but he's going to have to get them passed. You know, like Bob was saying, it might be hard to get those passed.
Yeah. Question?
How does the Doge stuff factor in? So like, this is all
Yeah,
deficit. So
Doge
less
would be a spending cut.
Yeah.
So again, the way reconciliation is supposed to work, they're supposed to identify specific spending cuts. So if you had spending cuts, that were specifically identified and in the budget reconciliation bill, they would count
So there we go.
to offset.
Yeah.
So are you just gonna come back in your final, you're gonna, of all the tricks?
That will come back.
Fast forward to the end. Okay.
But I mean, so you have two big pots of money that could offset the 7 or 8 trillion in tax cuts.
Right.
One is tariffs. So I think tariffs are particularly controversial. They can be done by executive order. And as we'll see, Congress could change the budget reconciliation rules to say, okay, if it's done by executive order, it counts, even though we won't do it as Congress. I doubt whether Congress would pass these sorts of tariffs themselves. Many people in Congress, including many Republicans, are still of a free trade persuasion. So I'm not sure that's ever going to happen, that Congress is going to do it. But changing the rules has more of a possibility. And DOGE is the other one in terms of spending cuts. Again, those are supposed to be specifically identified in budget reconciliation. So far, we don't have that. And we don't even have, I think the report is due at the end of June or the end of July. So it will be a while before that happens.
There is some thought about, I think too, that maybe the people might be willing to stomach a bigger number for the reconciliation bill. You know, so maybe it's not explicit, but they might think, well, we know the spending cuts are coming.
Yeah.
So it's
Back
very,
in one of all the
There-
real tariffs are maybe, right?
Yeah.
So we can't use them, but maybe that gives us ability to say the deficit, increase could be higher.
it's just how much.
There's even some better tricks than that. Wait a year what they can do.
Okay, let's just, so the difference between now and 2017 is we run up a lot more debt since 2017. So go to the next slide and just give you a sense of how much more we've run up here. Michelle?
Yeah, so now our national debt is sitting at about 36 trillion, give or take. So this is a massive increase over time, and it's just growing more. I'll show you on the next slide. The debt to GDP ratio is running around 100% and projected to increase. And our deficit for 2024 is projected to be close to 2 trillion. So these are getting to be massive numbers. If you go to the next slide. Thank you. This is debt to GDP, and you can see we were, around 100% after World War II, but the optimism in the country and the things that were going to happen here was much higher, and we got that debt down. It was more driven debt, and you could see since the Great Recession, basically, we've been on a quite steep upward trajectory, and it's expected to get much more steep after, going forward. And part of that is because of the aging population, increased healthcare costs, and just the notion that we continually spend more than we bring in, and there's nothing in the foreseeable future that makes us think that would stop.
We've never had such big numbers except in wartime or when there's been a recession. Now we're in a strong economy, but we're still racking up some really big deficits.
And how does that compare on the world stage, Michelle?
Europe, there's a joke kind of that, we look good because of Europe. It's a lot of countries are in this kind of same situation, that they have a high debt to GDP, but that still doesn't make it palatable in a lot of people's minds.
So everyone's doing this, right? US is doing this, Europe is doing this. So what's the implication? Like, nobody stops it. What, I mean,
Well, the next slide it ultimately has to do with the interest costs that are built into this. Michelle?
Yeah, so our interest costs are rising, and you can see in this year, our interest costs were quite high. They increased quite a lot because our debt levels are high and interest rates went up. And in fact, this year, our interest cost was equal to or slightly greater than, I think, what we spent on national defense. And so, and it could keep rising over time.
So for years and years and years, there were many members of the House Senate who were deficit hawks. They were worried about this. It was going to these are the termites that were going to undermine the foundations of our economy. And that,
So far, it hasn't happened. That's partly because the U.S. is a reserve currency. But there is a tipping point, but we don't know where the tipping point is. And you're right to say that lots of people in Congress now say, well, maybe we ought not be that concerned about deficits because we managed to go from 50% to 100%. Nothing bad has happened. So maybe if we go from 100% to 200%, nothing bad will happen. So we don't know.
but we did learn with all those crazy derivatives around mortgages in 2008, 2009, that you think it's riskless until it collapses.
Right. It's
Right?
not, yeah, it's not a problem until it becomes a problem. Okay, next slide. We'll just finish up with two more slides here. So I think that there are going to be a lot of Republicans who are going to have choke on a $5 trillion TCJA extension. And therefore, we're going to very likely see some, I would say, some permanent extensions of the business provisions, but the individual provisions, which are much more costly and much more popular, can go 5 years, and they'll figure after 5 years, Congress will just come back and reinstate them. There's also
So you're saying punt it. So just use math. Say it's not 10 years, it's just 5 years. Therefore, it cuts it down to 2.5 trillion.
roughly, yeah, roughly, and that's definitely a procedure that's been used in the past and maybe in the future. There's also a lot of discussion about trying to have two bills, trying to have different bills, have a immigration energy bill go first, etc. But you could theoretically think of a smaller Republican budget reconciliation bill and then a consensus bill, for instance, on the individual brackets and itemized deduction, but having the standard deduction go up. But that implies that Democrats are going to play ball the Republicans. I'm not sure that that's true. I don't know. Do you have a view on that, Michelle?
Yeah, we don't know, but there are schools of thought that would say that there's going to be a bipartisan bill as one, and then a reconciliation bill as the second, but they have to be.
So if you were to just kind of characterize the bipartisan piece, that we say, okay, that's going to be good. Is that going to be for under a certain threshold?
That will be under for income tax rates under 400,000, and for increasing standard deduction and personal itemization. So that probably,
And maybe child tax credit. I would
yeah,
say.
child tax credit too.
Yeah.
So that might be a total of, 2 or 3 trillion. I don't know. It's, wait, trillions are thrown out.
Yeah.
But something like that. Now we get to the
We don't
last
do
slide.
this every 5 years.
Excuse me?
Is this only done every 5 years?
No, it's usually, the budget reconciliation can be done every year. But
So maybe if things go well on the 26th, there's more Republican senators that they would redo.
I doubt that. This is such a painful process.
So then
And remember, you have.
Trump probably doesn't want to do it more than once, I guess.
Yeah, right.
Is that right?
Correct. Now, last slide just says, all these things we talked about have to do with budget reconciliation, which is established by a budget act. But there are also lots of possibilities for interpretation. And I just give a few of these as ways to reduce the number from 5 to 8 trillion down to something in the 2 trillion neighborhood. So one is to count tariffs. We talked about this, even if they're imposed by executive order and not legislation. So that would be a way, assuming that Trump is a lot clearer about what tariffs he's imposing.
Do we have any numbers on tariffs that have been collected from the original Trump tariffs and they're continuing now? Like some numbers were thrown around back in 2017 or 2018 as tariffs were being established with China. Do we know was it one of these things where she, and we're gonna make 300 billion out of this, but then the results were people shifted trade out of China into lower tariff areas, and so the net result was we didn't get 300 billion, we only got X. Do we know what, like, the effectiveness has
I
been?
think there are people that made estimates.
Yeah, I just don't know it yet.
But it clearly, there's a lot of shifting out of China. And that will reduce the amount that tariffs have done. I've seen numbers like the China tariffs generated 200 or 300 billion, but we're not talking about 5 trillion.
Right,
So it's a lot lower number. But
no question.
we have Doge. That's the second bullet there. That is, again, you can offset the tax cuts with the spending cut, and Doge will come up with spending cuts. You're supposed to actually identify them in the budget reconciliation, but they can just hypothesize. The other thing is, if tax reform is pushed to the second part of the year, then maybe you'll have some more specificity in Doge. But again, it's easy to say, let's take out $1 trillion, it's much harder to get Congress to actually pass something like eliminating the education department, eliminating other agencies. That's not so easy to do.
Like Medicaid or certain safety net programs that are kind of outside the sacrosanct Social Security, Medicare, defense, and interest. You're still only left with what, 30% of the overall?
Yeah, it's not a big number. It's something like 30%, 35%.
Right.
The other thing, you can reduce revenue loss by stimulating economic growth. This was done in 2017. They run what they call a dynamic set of numbers against the static set of numbers, and they speculate that there's going to be more economic growth, which produces more tax revenue. To some degree, this is valid. The question is, how far can you take it? I don't know. You've been on one of these congressional committees. So
Yeah.
What do you think?
I mean, I think in the 2017, when that happened, I think it was overdone. Like, I don't think people that actually wrote the rule thought that it would pay for itself or it would generate, all that much revenue to offset. But some couple people did say it, and then it kind of, the press ran with it a little bit. So I don't think anyone thinks that these things will pay for themselves by any means, but it will, like Bob said, it will raise some revenue, the dynamic effect. But how much it will offset, we just don't know. And that presumes no crisis or anything else that comes up, like COVID or financial crisis, something like that, which obviously
Kinetic war.
something, yeah.
And
You
then
have a question? You have a question?
Yeah, so Rick, if we're talking about the tariffs and if they will be applied, this will provide the consumer prices go up. So, and the question, like here in Massachusetts, do you see that local government can help people like survive in this?
well, they can hand out, they can hand out food stamps, they can hand out subsidies to low-income people. But I think what you're saying is very important in terms of economic growth. You have tariffs and they raise prices. It's not going to increase economic growth. It's going to be a burden on economic growth. So that's just another way of saying our tariffs and economic growth, are these just like speculation as opposed to anything in particular?
It's speculations that can destroy a lot of businesses and lives.
Absolutely. And the last thing is this notion of current policy versus current law.
Oh, I love this one.
Yeah, so they say that we take what's current policy now, not what's going to happen. So that's essentially a fancy way to say we're going to ignore these expiration dates because we're going to say we're going to look at policy rather than law. And that would be a way in which you could eliminate, say, $3 trillion of the cost of extending this TCJA, because you would say that most of these things were just.
All right, so what you're saying is I'm losing 300 billion a year, but because I'm doing this, I'm not going to count it as if I'm using it.
3 trillion.
No, but I'm saying 300 billion per year for 10 years is 3 trillion. So I'm going to believe it doesn't exist. and then I'm gonna just continue piling on.
Correct. I'm gonna make
Right.
believe by saying that we're assuming that current policy is extended. And therefore, we don't look at the fact that under law, they were going to expire. And there's at least one senator who has talked about from the budget committee, he likes this thing. So you could see, for instance, the extension of a large part of TCGA, except for salt. Salt doesn't operate that way. Salt's a restriction. So if they count that as current policy, the current policy is restricted. So you could see extending most of TCJA. Number one, salt being raised to 20,000, which would be a loan given to various constituencies. The corporate tax rate going from 21 to 15% for domestic production. And, you know, you could see that package as being something that
And you do it only 5 years.
you would do it in 5 years.
So putting all of this together, if you're trying to figure out what's going to happen to you, the person, or your company in 2025, 2026 and beyond, what's going to happen in 2025, what's going to happen in 26 and beyond?
Well, almost everything extends from 24 to 25. There are a few corporate provisions that are already petering down, and those will those will come into effect in 2025.
So we don't need to do anything between now and year end this year. It's really between now and December of next year. Personally, right? We should be thinking about that.
Well, I would say next year is going to be the same as this year, personal.
Yeah.
But the question is between 2025 and 2026. And I would say there's a good chance that most of the TCGA will be extended. And I would say the corporate side especially, because it's got a much lower cost to it, because the rate decrease was made permanent. And I would say a lot of the individual provisions, those will come into play and be extended in 2026. Whether any of these new tax cuts that have been bandied about will come about, that's really hard to tell.
Well, what about the business provisions, the R&D, the interest depreciation? Do you sort of think of them as separate?
Yeah, those will, in 2025, they will be what the TCJA says, which means they'll be reduced somewhat. But I think it's pretty highly likely that they will go back to a much more favorable provision in
So they're going from
2026.
So a limit of 30% on EBIT might go back to 30% of EBITDA.
Yeah,
Right.
I think they'll go back to what was actually put in place at the time of the TCJA. I think that's quite.
But you think of 26
Right, correct. But it probably won't be retroactive to 2025, just because, yeah.
So you think that's prospective? That's a.
They tried that.
The R&D one had a lot of legs for a while.
Yeah, it did,
Yeah.
it did. Yeah, they're calling next year the tax Super Bowl or tax Armageddon, so I think, there's gonna be a lot of tax activity and people are saying a lot of things are on the table.
Yeah, so regarding this, we can expect that, next year, nothing drastically will change. And yet, the next year will be full of chaos and noise that will be generated from different sources, different cases. What's your advice or where to look at? What source of information to choose? Yeah. But what specific source of information experts can recommend?
Well, I will say this, that MTLC knows that something we didn't talk about was immigration policy and the implementation specific of tariffs. And MTLC is planning an event, I think in February.
Yes,
Oh,
Yeah.
nice.
because there's really not much you can do until after the inauguration with all of this. And so this is more getting us up to speed with things that are happening one way or the other.
Well, they're more knowable. I mean, you did this event back in 2016, Bob. I think it was in December of 2016. Most of all of your predictions were pretty much spot on because this is kind of like, it's not super political. It's not gamesmanship. It's real money and for people and businesses. And
Yeah, if I had to have a crystal ball, I would say between 25 and 26. And in 2025, I think all of the individual income tax provisions will be extended and the business provisions will go back to where they originally were in the TCJA. So they'll go back to where they were in 2017. I guess of all the new stuff that's been thrown around, the domestic production is something that's a reasonable number and will get a lot of support and is consistent with its tariff policy. There will be, and I think that will go through budget reconciliation, and it very well might have a 5-year sunset, plus 5-year sunset, bring it down to say 2.5 trillion, and then some credit will be given to tariffs, some credit to DOGE, some to other things. So maybe they can get the number back down to 1.5 trillion. There are a lot of games that can be played here.
Let's see if, Kate, do we have questions online, either in the chat or from people who are beaming in? And you're on mute, Kate.
Yep, no, we do not have questions in the chat, but if anybody has a question, feel free to jump in. We know sometimes our chat is tricky to use.
Well, let's be clear. So we're saying the individual provisions are going to be extended. The business provisions are going to go back to where they were in the 2017 Act. Something will be done about salt. I don't think it will be brought back in fuller, but if the number will be raised, whether it's, I just happen to see a number, an estimate for go to 20,000. Maybe it will go a little higher. 20,000, 30,000. So those are 20,000, about 160 billion, 30,000, maybe 200 billion. So those are numbers that will satisfy. Remember, the House can afford to lose only really 1 or 2 people in the Republican majority, and you got enough people in the House from California and New York that they'll insist on it. That will be the condition of the vote. So that will be raised. And I think that's a package that we can have a high degree of confidence in. How it will be rationalized with tariffs and DOGE. I mean, those are other things that are pretty hard to predict. I don't know, Michelle, what do you think?
Yeah, I just also wanted to add, I guess, a little bit about tariffs. You know, there's a lot of things that might make people fearful of tariffs, but I think there's a reasonable level of tariffs and the threat of tariffs that could be useful. And if you think to the tariffs that the Trump party opposed, I mean, the Biden administration did reverse them, you know, so I think there are some good uses, and our trade imbalance is wildly out of whack, you know, and maybe we need to fix that a little bit. Our tariff rates are quite low, so maybe there's some medium ground that doesn't cause any problems and does some good things with use of some level of tariffs.
Well, the thing that I found really interesting is the $1.2 trillion of net exports that, you know, we're not getting with others. You know, about half of it is with Canada and Mexico. They're integrated into our economy. So like if you slap 25% on Canada, which is against our treaty right now with them, you destroy the price of gas in, you know, all the oil from Canada that comes down from Alberta and so forth, provides the entire middle part of the America its petroleum it needs for gasoline, and gas prices go through the roof.
Yeah, I think the chances of 25% tariff actually being put on Canada and Mexico are pretty low. On the other hand, I think there are specific things that people want that tariffs will be used as a weapon to get. I'd be very surprised if the number went up to 25%. For China, he just suggested a 10% increase. I can see that as going much higher. So.
All right, so we are almost at time. So you're going to get everybody in here and zoom out a little bit. We've had a whole bunch of people online. We've recorded this, so we'll put out a synopsis.
Yeah.
You're going to walk out of here as promised with all sorts of new acronyms, numbers, reconciliation process, the games that are played to make it sound good. But I come away, at least for me, confident that I kind of understand what's likely to happen, and I'm not as freaked out as I was coming into this. trying to see where the pieces might fit in. There's still a lot to come with DOGE, tariffs, trying to move hundreds of thousands or millions of people out of this country. I can't even imagine the impact that would have. We'll talk about that, I guess, in February. Because we'll know what's bluff and we'll know what's real by then, right?
I think we were trying to cover the tax provisions and putting in immigration is like a whole other ballgame.
But right,
Yeah.
you mentioned it, you talked about, there's a difference between like the economic growth, right? And we didn't even touch upon
Yeah, if you really deported 11 million people, it would be bad for economic, not good for economic. And if we imposed the level of tariffs that you're talking about in Mexico and Canada, that would be bad for economic growth. So I think there's a lot of hyperbole running around here. We'll see what actually happens. But the tax process, if I had to guess, it will get pushed back to the second part of this year, just because one thing that happens is you get by-elections, so you get more House people coming in. So the spread is a little bigger in terms of that. And second of all, I think when you get more specificity on tariffs and DOGE, then it will help process.
We can turn this off. I'm sure if there's any last questions for the people.
Thank you very much.
Thank you so much. Jim, thank